JBlog, 29th of August 2010. Starting out by looking at the New York Composite. Friday, as you can see, was a pretty strong day. The Fed was talking. That usually moves markets. But in general, the last 3 weeks have been very weak. The market is now at a relatively oversold, technically oversold point, and a little rally here is not surprising. Stochastics are down, and that constitutes a need for a bit of a snapback rally. I wouldn't put too much weight into it, but that's the market does need to revert to its mean from time to time. When we look at the weekly chart, we still see that even though this could be a bottoming candle, the 1030 has crossed over around here. And let's see, October is coming up, November is coming up. Those are usually pretty bad months for the market. In September, the fund managed to return from vacation and make some readjustments. October, November, if there's some ugliness, that's usually the time of year that the ugliness happens. Here, of course, we have 2 years ago we had the September, October, November downfall all the way into March, and since then it's been climbing. Let's go over to oil as the indicator, how much energy is needed, which tells us something about the economy or where the market thinks the economy will go. Again, oil was very oversold, but it has broken a trend line here. There was a little trend that established itself that was broken. Another one that was broken is natural gas, fell down quite badly in the last 2 weeks, which says something about manufacturing expectations in North America, as well as, of course, an oversupply of natural gas that is coming online. Gasoline itself was moving on Friday along with oil. On the gold side of things, gold is once again almost to its high, all-time high and yearly high. $20 off by the look of it. Latest things, people are now expecting gold to break the 1300. It's interesting how gold bounced off this trend line quite nicely, and it is very likely that it will go higher from here. Eventually, gold and the Dow will once again trade at 1-to-1 or close to there. So that basically means that gold is most likely going to go to 3,000 and the Dow will go to, let's say, 4,500. There's a long-term, very, very long-term trend in the Dow that goes back basically a century. And that's technically where it should go, where you would find fair value. That's really when it would be oversold. So gold and Dow will eventually meet once again, as they already have 3 times this century. Silver had a nice bounce on Friday and actually this last week. So that's good to say. So the gold-silver exchange is once again going down. The VIX, I drew a wedge here. So question is, where will it go Friday? Put everyone's mind at ease. I don't know why. I don't know what Bernanke said that is so positive. But let's switch over to the news. Here's one thing I've noticed over the last year. The news reports the news and then automatically gives a reason why things happen. US stocks drop over concerns over Spain stability and manufacturing slowdown. No, stocks drop because people sell them. It's that simple. It has nothing to do with Spain or anything of the sort. But I love it how they always have the pat answer. Oh, we know why this happened because this. And yeah, go back to reporting news. I think it's better. GDP, of course, fell to 1.6%. Again, wonderful headline here. economy in the US grew better than estimated 1.6, revised from 2.4. So it used to be 2.4, then it dropped to 1.6, but because everyone was expecting even less, this is good news. 1.6 is dismal. I wrote a piece on that. 1.6 is basically your population growth. There's no GDP growth whatsoever because basically this population growth along with inflation accounts for the 1.6. We are really back in recession at this point. Um, so that's a silly article. This is interesting here. Investors are pulling $7.1 billion dollars from stock funds worldwide. Basically, as I've been saying, individuals are pulling money out of the stock market. They're tired of this. They're tired of the uncertainty. They want to buy something that gives them a steady return. They're going into bonds. They're going into places where they expect better growth, and there's a pendulum that basically swings against the stock market, which will not be good for the stock market. But of course, on every first of the month, you have new funds flowing into the stock market in the form of retirement funds, which are not really there for your retirement. They're there to provide cheap financing for companies. That's really what that is all about, which will naturally um, keep supporting the market. You don't have a choice. I mean, your pension fund is going to be invested, and Wall Street is going to pay itself bonuses for continuing to invest in the stock market. Whether it goes up or down, it's of no concern to them. Um, so another one, Bernanke is says the Fed has the tools to prevent a recession. Yeah, that worked so well last time around, but he doesn't want stimulus. I don't know. He spent $6 trillion. The U.S. government in general has spent $6 trillion trying to avoid the recession. We are in a recession. Maybe not on Wall Street because their bonuses still run in the billions, but everywhere else we are in a recession. Bernanke once again says he will do all he can to safeguard the U.S. economy. Bernanke, just don't do anything. Okay, you're breaking things. It's pathetic. Um, Here is uh, several economists who do see significant risks. Again, I don't see a significant risk of a second recession because we're already there. So I don't call that a risk. Rubini, of course, is another one that is expecting more downside. I continue adding to my blog, which you can find at blog.oakwise.org. And this particular article here deals with new taxes that are coming up January 1st that will take extra money out of the pockets of Joe Blow, which will give them less money for buying things. 1%, 1.6% is dismal. Here I talk about the EMA 1030 crossover, just a little blurb. I try to put something down every every once in a while when things come up. Come visit that. So blog oakwise.org, and outside of that, I don't really have anything else. Oh, well, we might as well just, seeing that we have another minute here, talk about dividends. Once again, dividends are 2.07%. So all of these earnings have not yet translated into anything. And our PE ratio after this drop is still at 1955, which is far above the mean and the median for the S&P, and much further if you exclude this particular piece here. So the market continues to be over valued even where it is after this correction. So all I got for today. Good luck, happy trading, and make lots of money. Bye.